What I'd like to do before I get started is just take a very quick poll of people who are actually in the room and just ask, can you stick your hand up if you work for a non-financial corporate? Okay, and can you stick your hand up if you work for a financial corporate? A few of you, and I'm presuming the rest of you work for government, for NGOs, for a variety of other areas, but at least one good thing is we're not primarily financial corporates in the room. I've heard a lot of really interesting discussions over the last day or so, and there's been a real common theme coming out of that. And some of that was mentioned in the panel just before. We're talking about innovation, we're talking about information, we're talking about integration of ESG, and I think above all we're talking about education. It's an area that's difficult to understand, that is perhaps more complex than it seems on the surface. And speaking of complex on the surface, I shall see if I can get this to work. Yep, there we go. That's nice. It's got a large green button with a forward arrow on it, so I'm safe with this one. So in Fitch Ratings, we are basically in the business of providing information and education to both investors and the market. We provide independent, objective opinions on entities and transactions. And traditionally, we've done that around credit. And one of the important things to appreciate about ESG is there is a big difference between looking at ESG from a credit perspective and looking at it from an equity perspective. So if you're an equity investor, your considerations are different from if you're a debt investor. And there's a short and easy answer as to why that is the case. And that's the case because if you are a debt investor, you're interested in downside protection. So what you want to know is, will I get repaid the loan that I've extended to you on the date that that loan is due? If you're an equity investor, you have far many more considerations that you can take into account. There's upside for you. You can think about the longer term. You can think about different time periods. And a lot of the work around ESG originally came about for equity. And the adaptation of that to debt investors has not actually been particularly well done or understood. It's getting better, but there's a lot of work that needs to be done around that, and we've been doing a lot of that work over the last 4 years. And so I thought I'd give you a very short presentation. I mean, 10 to 15 minutes on this is, given the complexity of the topic, is pretty short, but I'll do what I can. So we created Sustainable Fitch as a focus for ESG within our company overall, and that is to bring together a separate level of expertise that is not credit-based expertise, but that can help the credit-based part of the business in integrating and understanding ESG, and we've done that. I'll talk a little bit about what we've done there. But then can look beyond that and can try and provide investors in the market with the same level of research and information that they're used to seeing to help enable them to make credit decisions around the pure ESG aspects. Now, ESG is complex, but it isn't new. And a lot of people talk about ESG as if it is environmental predominantly. And the social, I think, now is being talked about a lot more, particularly after the last couple of years. But governance is also important. And I'll illustrate to you the difference between how important these different aspects are when you look at different parts of ESG, from a pure credit through to a holistic ESG performance perspective. So within our business, back in 2018, we set about integrating ESG into our credit ratings decisions that we make. And we rate an awful lot of businesses, and investors use the credit ratings that we have to help them make decisions about whether or not to invest. And when it comes to credit, it's all about probability, timing, immediacy, and impact on cash flow. And so what we did was we looked at what investors were asking us to do, and they were basically saying, we understand that when you look at a credit, you're required by regulation to take account of all things that could be material to that credit rating. And so we appreciate that when you come back to us and we ask you about ESG, you say, well, if it's important, it's incorporated in it, so don't worry about it. But actually, as an investor, I'd really like to know, when it comes to greenhouse gas emissions, is that affecting this credit rating? When it comes to social impact from the company on the society that it's operating within, is that causing an impact from a cash flow perspective? I want to know the specifics of it. And so what we did, developed a framework that extracts from our credit ratings analysis the elements of E, S, and G that have impacted the credit rating and displays them separately. But it does that on a value-neutral basis. So here, when we're looking at ESG purely within credit, we're not looking at good or bad behavior. We're looking at the credit outcome from that particular environmental, social, or governance factor. And the way I like to illustrate this, and I think it helps people understand a little bit clearer about what a difference it is when you look at credit. If I'm a renewable electricity generation business and I generate all my electricity from wind farms and I sell that into the market, is my credit profile better or worse than a coal-fired power station? Anybody better than a coal-fired power station? Worse than a coal-fired power station? Don't want to make a decision? That's fine. And the answer is, and you're right not to put your hands up, is it depends. Because your credit profile is only better if the environment that you're selling into supports your cash flow. And something like a wind farm generation business, if it sells into a market where there's priority of dispatch, so the system's been set up and it says, if you're a renewables generator, we will always take your electricity first, then that's credit positive for you. If it also says, we'll take your electricity first and we'll guarantee you a minimum price level for that, then that's very credit positive. And in that circumstance, from a credit perspective, it's very positive. However, you could be exactly the same business producing renewable electricity from wind farms, and you could be in a market where you sell into what would be called a merchant market, which means that they'll only take your electricity at the cheapest price and at a point where they need it, and it's cheaper than other suppliers. And there you're a pure price taker, but you've also got the problem that you don't know when the wind's going to blow, so you don't know when you're going to be generating. And therefore, your credit profile is probably far worse than a coal-fired power plant then, because that coal-fired power plant can decide, oh, prices are high, I'll run up over the next few hours. Or I see a demand peak coming, I'll run up over the next few hours. So if you're looking at it purely from a credit perspective, you have to look at it from a value neutral. So you're looking at, are the financial projections impacted? And this is what investors were coming to us and asking us very specifically, because they use the credit ratings to help make their investment decisions. So if there was a credit rating of BBB, they want to know, is that credit rating influenced by greenhouse gas emissions? If it's suppressed by one notch and the company is doing something about it, then can I anticipate that it's going to improve in the future? However, that's only a very small part of the overall view that people take when they're looking at ESG. And investors in particular will take a longer term view because they build portfolios, they have asset owners who are asking them to report on certain impacts and influences. And so the next question, once we've done this and we've fully integrated it, so we've trained over 2,500 analysts in using this framework. Whenever we produce a credit rating, you get a set of what we call ESG relevance scores for an entity, just as part and parcel of that. And so for 3 years now, we've been producing about 145,000 of these, and we monitor and maintain them on an ongoing basis. It's interesting and it's useful data. I'll show you a couple of examples. But what then happens, of course, is your investors say, well, that's great, but I need to think about climate risk, and climate risk is a longer term issue. There's a lot more uncertainty around that. And we kind of want to know, how does that affect credit in the future? If I'm building a portfolio, when should I be moving things in and out of my portfolio? How should I be looking at that? And so what we developed there was we developed a scenario-based product called a climate vulnerability score. And what that does is it looks at industry sectors and it says under a 2-degree scenario, and we use the United Nations Inevitable Policy Response scenario as the basis for this analysis. It looks at that and it says, if I look at all the industry sectors around the world, I look at all the net zero targets, I look at what it takes to get me to 2 degrees by 2100, what are the policy initiatives, regulatory changes that have to occur in each and every market around the world? And if those countries are going to meet their objectives, what has to happen? What are the carbon restrictions that are put in place? What are the pricing regimes? What are the extra costs that are landed into different industries in order to reduce environmental aspects or to improve social factors. And it looks at that and it says in particular on the environmental side, how do the risks develop in different countries? And if you look at something like coal, for example, in Europe, coal has a very high existential risk at the moment because it's being phased out. There's a lot of legislation that's designed to phase it out, and so it's not a great business to be in. If you look at exactly the same businesses in China or India, which are dependent on coal for electricity generation for at least the next 15 plus years, their credit profile doesn't deteriorate to that extent until around about 2037. And so when you start to look at these different industries, you start to even look at the same industries around the world, you can build up a profile that says, actually, if we are going to get to 2 degrees, these are the regulations that have to be implemented in different countries. This is how it affects different sectors. And this is what it means for companies in that sector over time. So you might look at the ESG relevance scores and the credit rating, and you might say, well, I'm looking at this entity, I see no impact from environmental factors. They have to manage some of it, but it's well managed. There's no change to their cash flow. There's no impact in the next 3 to 5 years in the forecast that you're looking at. So I can be relatively comfortable that I'm not going to get caught out if I'm a debt investor on that. But you might look at that and you might say, but I can see, however, that this company is active in these 3 different countries. And in the future, those 3 different countries, their activities start to become a high risk from a credit perspective in 10 to 15 years' time. So if that company then comes to issue a 15-year bond, an investor may well turn around and say, actually, I either want a lot higher reward for that or I'm not prepared to do it because I don't think you're taking the right actions to prepare yourself for the future that we can forecast under one of these scenarios. Now, it is just a scenario, and a lot of investors use different scenarios, but it was the one that we felt was the most comprehensive and transparent that was out there in the market. So you have that short-term credit view. You have the longer-term, what happens with climate risk? Does credit risk build up? Is this company going to be more or less exposed? Do I want to invest short-term in Europe and long-term in China? And will that give me a good return? And maybe I can facilitate the transition in China because I'll invest only in green bonds for coal companies who are phasing out that type of generation. So it helps to inform people and to understand the longer term view. But then, of course, at the end of it all, there's the pure view on ESG. And so you can see the short term, you can see the climate risk, but ultimately, if that climate risk credit score is building up over time and there's nothing that is affecting the company currently, what you then need to know as an investor is you need to know overall all of the ESG practices of this company, how well are they being managed? Are they taking account of those factors that will lead to that credit risk build-up or not? Or have they got their head in the sand, or do they think it doesn't matter? And so if you're going to try and complete the picture and you're going to move from that pure ESG, how well is ESG being performed within a company, through to what's the specific credit impact, you need that piece too. And that's where we launched a business in September of last year called Sustainable Fitch, which looks at that pure ESG analysis. And I'll tell you a little bit about what we do there and what's important from a company perspective, because I think that's probably the most interesting aspect of it. So just to give you an illustration, we'll go back to remember I talked about the integration with credit ratings. And this just gives you a little example of how environmental, social, and governance factors drive and impact credit ratings. And this is just a sample of 1,689, to be precise, we're analysts, 689 corporate issuers. And you can see that if we look at all of the environmental, social, and governance aspects that we look at across those companies, you can see that the highest proportion of impact on credit profiles is coming from governance, followed by social risk factors and environmental ones. And that's maybe not, for investors, the governance aspect isn't surprising. Governance does tend to drive a lot of companies. If you think about oil and gas companies, for example, if they have a large spill that causes an environmental disaster and huge fines, often that's because they didn't follow procedure or process from an operational perspective that caused that accident to happen. And so causality is very important for investors, because if they're trying to avoid that downside risk, they're interested in the causality. But you can also see, if you look on the left-hand side here, of those 1,689 entities, only about 420 of those are being impacted by ESG from a value neutral perspective in their credit profiles. So that short-term 3 to 5 year forecasts. And you can see there, we have a scale of 1 to 5, where 5 means a factor by itself, like greenhouse gas emissions, is all by itself causing a change in the rating, and we can say that's 1 notch, it's 2 notch, it's an outlook that wouldn't have been in place otherwise. Then we have what we'd call medium impact, which is you've got a series of factors which in combination cause a change, or maybe you've got a weak credit profile plus a high level environmental risk that's causing you to spend more money on retrofitting your equipment, and that leads to a cash flow impact in the short term. And so you can see that there's, it's relatively small when you think about it. If you look at that sample of company, 23%, most people would expect maybe it should be larger than that. But again, it's on the value neutral basis, so it's pure cash flow and credit. Now we do this in a lot of detail, and this is really just to give you an example of that. When you do it to this level of detail, what you can do is you can slice and dice by issue. So here on the left-hand side, we have the main issue categories that our analysts look at: greenhouse gas emissions, energy management, water and wastewater management, waste and hazardous materials management, exposure to environmental impacts and disasters under the environmental category, human rights, community relations, access and affordability, customer welfare, blah, 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 under social, and then for governance aspects. And we produce a lot of information on our website, which is free and easily accessible. And you can go on and you can explore the issues. And you can explore the issues by industry sector, which is what this chart does. It's an interactive one. So across the top, you can't really see it because it's very, very small, but you've got 51 different industry sectors. And then under those 51 industry sectors, as you work your way down through these issues, where you see a red or an orange square, it's basically telling you there are companies in this sector which are being impacted from a credit perspective. If you hover over those when you're on the interactive page, it'll pop up, it'll tell you which companies they are, and then you can click through and find out more detail about them. You can also explore it by theme now as well, so you can say, actually, I'm interested in water and wastewater management, and I want to look at that, and I want to narrow it down to a couple of regions and maybe 5 sectors, and so you can start to explore differences between companies there. So that information enables you to do a lot on a credit basis. It enables investors to differentiate. What about that longer term climate risk aspect that I talked about? Well, this is just an illustration of, if you drill down to that sector basis, and here we've got some US entities. We've got a US gas networks and nuclear company, a diversified European renewables business, a European renewables and transmission and distribution business, and a US coal, gas, and electricity business. And the US coal, gas, and electricity is the white line at the top there. And you can see there that the credit risks over that time period to 2050 are clearly building. You can see for the US gas networks and nuclear, they're also building. And for the renewables entities, perhaps not surprisingly, they're not building very much over that time period. So again, when you start to produce this level of detail, it really helps people drill down and look at, if I'm looking at utilities in particular, what about subsectors in different countries? Again, if you go on our website, you can find reports on utilities, oil and gas, natural resources from a climate risk perspective. And over the next 6 weeks, we'll be launching another 15 sectors where there'll be reports, probably most of the industries that you're involved in this room. So telecoms, retailing, all sorts of different areas. But then there's the pure ESG aspect of it. And what we found when we looked at this about 3 years ago was we looked at it, and we've taken a slightly different approach to our competitors, because what we looked at was a lot of niche businesses in the market that had been grown to serve a particular purpose, but none of them to provide an overall and holistic view on a granular basis. And so we spent quite a lot of time talking to investors about what they really wanted, and also talking to asset owners who were providing the money to the investors, so some of the insurance companies, the pension funds. And it was very clear and very obvious, and I'm sure it won't be a surprise to any of you in the room, that everybody was doing it slightly differently. There wasn't a common aspect to it, even within large pension funds, insurance companies, large asset managers. Different areas within those asset managers were using information differently around environmental, social and governance factors, depending on what type of portfolio they were constructing or what type of returns they were trying to achieve. And what became obvious to us was that you needed some form of granular analysis around ESG that really looked at the detail, but then provided that detail on a modularized basis so that you could drill down, and for an entity you could look at what actually mattered. And impact and outcomes for investors have increasingly moved up the agenda. Speaking of the agenda, I'll do a very short time check. And so what we did was we developed a methodology to produce ESG ratings for entities and for debt instruments. And with the debt instruments, we can look at what we would call framework instruments, which are ones that have a use of proceeds purpose, so green, social, sustainable, or KPI-linked debt instruments where there are specific performance targets integrated into those. And so we have a methodology for analysing the quality of that framework, and we provide International Capital Markets Association alignment. We can look at EU Green Bond Taxonomy alignment. For social bonds, we're looking at contribution to UN SDGs. But there's a very detailed analysis of the use of proceeds, the way in which the debt instrument functions, and all the reporting surrounding that as well. But most importantly, when it comes to the entity itself and the entity analysis, we looked at this and we built an analysis framework that focuses on what investors were asking for. And it's extremely important for any of you who are thinking about dealing with investors. And what we found was there was a lot of fluff out in the market where people advertised, they talked about their policies, they talked about their aspirations, they talked about big picture targets without the science-based metrics to get there. And so what we did was we developed a framework that looked at it from a perspective of we will give weight to aspirations and targets for the future, and there's about a 10% weighting in there. That's the sort of entity information overview there. That's about a 10% weighting in our analysis. But then 45% of the analysis that we do rewards a company for the activities that it is undertaking at the moment. And it looks at the impact and the outcomes from an environmental and social perspective of the individual business activities. And it's not just, oh, it's a gas company. We'll look at each individual activity that there is, we'll assess the environmental impact, the social impact from that activity, then we'll aggregate it together to provide one score on using something like revenues for each of the different activities. So what you're doing now matters, and it matters in a sense, more than the future, because investors want to see a journey, they want to see transition, and where you start from is less important than where you end up, and demonstrating that you have that transitional path that you're following. And then, of course, we look at the overall policies and procedures for the entity from an environmental perspective, a social perspective, and a governance perspective, and we're looking there at aspects that apply across all the different activities, so we're not double counting. Perhaps a little bit too much into the technical detail. I mentioned modularity, I mentioned detail of what investors look at. Be aware, investors are looking at this increasingly in a massive level of detail. So this is each bullet point here is an area where we provide subgrades and sets. And you can see, for example, if you look under an entity and you look at the environmental aspects, then there are individual targets and grades for targets that we provide. There are disclosure grades, an evolution grade, a risk and incident treatment grade, a target and supply chain grade for environmental. There's a target and supply chain grade for social as well. So you've got individual investors who are looking at this and they're building portfolios where they'll say, actually, I care about 3 of these social factors because my investor wants me to look at building a portfolio that delivers impact in these 3 areas. And they will drill down to that level of detail. I'm aware that I am kind of at the end of my time, perhaps slightly belong. I'm getting a vigorous nodding from the back of the room there. But I just kind of wanted to leave you with this, which is really a summary of it. When it comes to credit, it's about understanding a detailed view of the entity's financial position and forecast from a value-neutral perspective, and that's what's important to investors. When it comes to climate, It's about thinking longer term. It's about understanding the scenario that you're looking at, being comfortable with the level of variables that are in there and the uncertainties around how industries and entities might react to how those variables pan out. But then when it comes to overall ESG, if you understand the detail from an environmental, social, and governance perspective, if you see the actions and the impact that the company is trying to achieve, and you can track and monitor that over time, then actually it fits very well with that credit aspect if you've got that identified, and that slightly more uncertain longer term aspect in helping the investor to understand why it might be worth investing in coal in China for the next 15 years, because not only is the return good, but they can help facilitate the transition and make sure that the entity that they're investing in through the debt instruments that they have is actually transitioning away from that activity. I'm very happy to take one or two questions, but I suspect I'll get a shake of the head from the back of the room. I see somebody with a desperate hand. If you want to shout loudly, please.
Yeah, very quickly. I'm curious, 77% does seem very high to me. And so are the scores going up because somebody's doing well, or are they more going down because they're...
From a credit ratings perspective, when it's value neutral, what we do is we identify for the investor, is there an impact from this? And then we'll assign, if it's positive, we'll assign a plus to it. The volume of positive impacts in that 23% is about 1.7%. So it's very, very low. And it tends to be where there are structural aspects that are supporting a credit profile due to actions of government in the sector. So you see it for regulated industries, for example, where if you're undertaking particular activities, there's a financial incentive. A good example where you have both would be the water industry in the UK. You have leakage targets if you're a water distributor in the UK. If you underperform your leakage targets and you leak more water, you get fined very heavily. If you outperform them, you can earn additional revenue from that.
Sorry, with this proliferation of ESG ratings providers and data providers, I was curious how you see the landscape evolving. Do we get the Moody's, S&P, and Fitch, on one side of the equation, and will there be consolidation? Because right now I think a lot of our clients are confused as to which provider to go with.
There's been quite a lot of consolidation already. It is very interesting when you look at ESG ratings, because you have kind of the high volume data scraped, low transparency end of it, where you get thousands of companies with a numerical score, but actually you can't, if you question that score, you want to know the detail behind that score, there's very little that you can find out about that. And the other end, where you have some very detailed granular analysis, but only on a few companies who've decided they want to do it for themselves. And so what we're trying to do with the work we're doing with our ESG ratings is to provide volume with granularity, so to take that middle space. So at the moment, we are working on an unsolicited basis to produce ESG ratings for every single green, social, sustainable, or sustainability-linked bond that is out there in the market. The highest level of coverage that exists out there at the moment on a data scrape basis is about 40%. We'll come out in September with 100% of all corporate and financial institution bonds that have been issued in that space. And by February next year, we will have covered everything. So Fannie and Freddie, structured finance, sovereigns, sub-sovereigns, and agencies, as well as the corporate. So we'll cover, if it's over 250 million, we'll cover every single green, social, sustainable, KPI-linked bond that's out there in the market. And so in answer to your question, yes, consolidation will occur. If regulation happens, even faster, because most of the small businesses are just not set up for it. It's not very profitable for most businesses. And Alex is waving me off the stage now with great enthusiasm. Thank you very much.